So, welcome to a lesson 5. In this episode, we'll be talking about investment funds, or etfs, and what these funds offers compared to picking your own favorite stocks and making a portfolio, doing all the homework, putting the time in to stay on top of the market, and so on. Index funds would do the same on a much larger scale and for the most part with lower fees. So following the articles from SPIVA scorecards as well as SPIVA US in 2023, it has shown that most active investors underperforms the market over time, meaning that most active investors and investment funds can overperform the market on a short term. But this overperformance is typically short-lived, as the longer period you focus on, the smaller the percentage of active investors beating the market becomes. In 2023, over 85% large cap fund managers failed to beat the S&P 500 over 10 years. And the S&P 500 is an index that follows the 500 most valuable companies in the world. And remember, this is professionals that spend their whole full-time job dedicated to managing the money of the investors in order to actively beat the return which the investors could have by investing in the market. These actively managed funds with experts and high personalities in the front will typically have higher fees. They normally have fees on managing your money. And then they also take a cut of the gains which you make throughout the year. And as we saw in the example with Carl, Bo, and Anna in the previous episode, both gains but also costs compounds, meaning that these costs or these fees, they're not only eating your profits this year, but also then hindering your money to be compounded next year, and next year again. And this amounts to a huge difference in the long run. And that's exactly what John Bogle, the founder of Vanguard, spent his whole life proving, that low-cost index funds, or ETFs, outperforms most active investors. Also on top of that, John Bogle argued that index investing is simple, it's cheap, effective, and if you invest consistently, you don't need to beat the market to make wealth. So instead of chasing returns, focus on increasing your income and let your investments quietly track the market. And this is backed up by Warren Buffett, saying that compound over time is your biggest advantage, where he argues that even modest returns grow significantly when invested over decades. Time in the market beats timing the market. And to top it all off, Warren Buffett actually in 2007 made a bet with one of the most popular actively managed funds, saying that he would bet $1 million to prove that S&P 500 would beat the hedge funds over time. And around 10 years later, he cast in the bet of $1 million. Eugene Farmer argues that the reason why it's difficult to consistently beat the market and consistently find the good stocks to make the good returns at the right time is because of the efficient market hypothesis, saying that all the information's out there already. So the yearly reports or the newest headlines of this stock's performance or the CEO of the company making a statement, all investors have the same information at the same time, meaning that as soon as this information is out in the market, it is priced into the stock. And that make it so that it is extremely difficult to find good deals consistently. And if you think about it, most of the stocks which you see completely booming overnight is because something out of the ordinary happened. And these sudden news, they just come out of nowhere. And what are the chances that you as an investor would be able to foresee all these huge news coming? That would be close to zero. And that is the main idea of the efficient market hypothesis. And I also thought to include Burton Malkiel with his popular theory in his book named A Random Walk Down Wall Street, where he explains that information of stocks, which we talked about the worst of a CEO or the annual reports or a big event that harms the company, for example, happens randomly. It's not consistent. And therefore, it is nearly impossible to predict anything about the stock and its movements. And since the movement of the stock on the short term is unpredictable, trying to do all these technical analysis with the SMH line and all this technical analysis of the stock is, from his point of view, mostly a waste of time. And you're better off investing long-term in something with a low cost and a diversification. And that is mostly what index funds are all about. It is about diversification. It is about spreading risk. And what happens is that instead of buying 1 to 20 stocks and having this single company risk, you have a bucket of, let's say, hundreds or even thousands of stocks, making it so that you, for the first part, you're not so dependent on your stocks as an individual performing. Since you own so many companies, if one or two or even 10 doesn't go as expected, then you have another sector. Then you own healthcare, you own agriculture, you own pharma, which have a great chance of being the booming sector of that year, and that would outweigh the loss in the first sector. Meaning that at the end of the year, even though you lost in some sectors, these losses were greatly outweighed in other sectors, and you book a gain for the year. And this might not be the biggest gain as you would have had if you, for example, picked Nvidia in the year where it was booming, but that gain you had came with a lot less risk. But second of all, with a lot less time consumed in having to stock pick in the first place. So baseline is that index funds, or ETFs, exchange-traded funds, balances global exposure. And by investing in different regions and economies, it helps you protect your portfolio from local downturns. To be super specific, I've put it up here, so you have stocks on the left side and ETFs on the right side. And you'll see that when you pick stocks, you go to market, you have to choose yourself. You invest in a single specific company at a time. By doing this, you have a higher company-specific risk, higher risk of losses, but also a potential upside with gains, of course, requires research and ongoing monitoring. There's a potential for rapid value fluctuations. And this is what we talked about earlier. These random news or information will have great effect on the value of the stock. And it is often a part of a more active investment strategy. So in total, there's a lot of work in having stocks, but this is also what some investors find thrilling and entertaining. Then, on the right side, you have ETFs, where you invest in many companies at once. You have a low risk through diversification. It is more a passive form of investing. You don't have to stock pick as you buy an index, which automatically follows a market of your choosing. It is broadly known as a stable and effective way of achieving long-term market returns. And it is suitable for investors with less time or experience. Let's say you're more on the right side and you want to spend less time and frankly just want to make a consistent return. What is important when choosing these ETFs or investment funds? And of course, this matter is subjective and it depends on what you want to invest in and which sectors that you believe will do great in the long term. For now, we'll talk about what will matter, whatever you choose, and that is fees. So we're looking for a fund. Can choose either an actively managed fund or a passively managed fund. The active managed funds will have higher costs since you have people actively buying and selling different parts of the fund. And I thought a lot about this because if you don't believe that actively managed funds can beat the market, why would you pay someone to do what you could be doing? If I want to buy the market as a whole and I stood between buying it passively with no extra fees or paying 1 to 1.5% for a fund to do it and they invest in the same funds in the same market, isn't it just throwing money away in some way? So we'll look at fees, and when you find a fund, you can look them up, and in the very bottom or in the very top, they will have these fees listed. So that's the most important thing, fees. But you also have to look at how good of a job these funds are doing in tracking what they're saying they're tracking. So for example, let's say the S&P 500 had a return of 10%. Does the index fund or ETF have the same return of 10%? Or is it 9.5, for example, or 9, or even 8? Because then low fees don't really matter if you do not end up with a percentage of what you should. So another thing that matters, both when you're looking into stocks, but also into mutual funds such as ETFs, is your risk profile. As mentioned, these index funds and ETFs allows you to buy out sectors instead of one specific stock